Welcome to our To Plan B or Not to Plan B. That is the question presentation, and our survey results of 150 technology company CEOs in the UK and Europe. Before we get to the survey results, we just want to define what is Plan B and why does it matter. Plan B is a plan that helps a company adjust and adapt to a crisis, even succeed in a crisis. Plan B matters because Plan A can fail, usually in an unexpected crisis, such as a financial markets crisis, which is beyond a company's control. Plan B matters because every CEO wants a predictable business and wants to be prepared, needs to be prepared. For example, in the 2008 to 2009 crisis, valuations of most technology companies fell by 40 to 50% in only a few months, and companies that weren't prepared with a Plan B suffered pretty badly. They couldn't adapt and couldn't predict what was going to happen. It's been 8 years now since the last crisis, and another one is coming. We've had QE and negative interest rates, and it's easy to be lulled into thinking that this is all okay. But it's not okay. And this time the crisis could be longer and deeper, and cause a lot more pain than the last one. And that's what this survey and research is all about. Now, before we move on, just to clarify, if you're the CEO or leader of a private company, do you care if your company's valuation declines by 40 or 50%? If you're private, does it really matter? Yes, absolutely it does matter, because it affects your ability to recruit and retain management talent, at least via share options, and it affects your ability to raise capital, to do share deals, and to achieve an exit. And yes, it affects your mood, which matters. Given the growing uncertainty in the markets, we recently asked 150 technology company CEOs in the UK and Europe how they felt about the markets, and specifically, do they believe market uncertainty will negatively affect their company's revenue in the next 12 months? And do they have a Plan B in place to act on as soon as they see the next market crisis or crash severely affecting their business? The results were interesting. Less than a third of the CEOs are concerned that market uncertainty would negatively affect their revenue in the next 12 months. As a whole, European technology company CEOs do not appear very concerned about market uncertainty. Even in the UK with Brexit, 60% of CEOs in the UK are unconcerned about market uncertainty. In Spain, this number rises to 80% being unconcerned, and 95% of CEOs in the Netherlands are not concerned about market uncertainty. On the second question about having a Plan B, 40% of CEOs admitted to not having a Plan B in place to act on when the next market crisis or crash arrives. Even in the UK with Brexit, 43% of CEOs in the UK admit to not having a Plan B in place. This number rises to 50% in Spain. In the Netherlands, 74% of CEOs say they have a Plan B in place to act on in a market crisis. Several CEOs offered their comments to us regarding the market environment and having a Plan B. Now, these comments are mainly self-explanatory and show that many of the CEOs are just not that concerned about having a Plan B, or believe that they are already inherently protected by having offices around the world or being able to just scale back. Not relevant for my company or my line of business was a common theme. But if you're running a technology company today, which is a very fast-changing environment, are you inherently protected by your business model or by having offices around the world to spread risk? Well, let's look at the last crisis to check just how deep a crisis can cut and how quickly it can happen. The last crisis in 2008 took at least 12 months to build up, with the demise of Northern Rock happening a full year before Lehman and the entire banking system collapsed. The signs were there. UK and European technology company output, in terms of the PMI index, started declining 2 years before the Lehman collapse, and then output tanked. And the valuation multiples of software as a service or SaaS companies were relatively flat in the year leading up to the Lehman collapse, but then they dropped by half in just 5 months. SDL, as a SaaS company case study, was growing nicely in the year leading up to the Lehman collapse, and then fell 40% in just 3 months. And its revenue growth rate fell from 35% to just 8%. And it wasn't just in software. Online gambling an industry in which some CEOs believe they're inherently protected against a crisis by their business model, also suffered. 888, for example, was steadily rising leading up to the Lehman collapse, and then its shares fell by 55% in just 3 months. And its revenue growth rate went from a positive 20% to a negative 4%. In the internet sector, the leading real estate portal in UK, Rightmove, was steadily rising leading up to the Lehman collapse, and then fell by 45% in less than 3 months. Its revenue growth rate went from a positive 31% to a negative 13%. UK IT company Computer Center remained relatively flat leading up to the Lehman collapse, and then fell by 44% in just over 2 months. Its revenue growth rate dropped from 8% to negative 2%. Stable UK software company Sage was relatively flat leading up to the Lehman collapse, but then lost 20% of its value in just 1 month. The broadcaster ITV was rising nicely leading up to the collapse, and then its shares fell by 45% in just over 1 month. The rate of its decline in revenue went from a negative 2.5% to a negative 7%. The market research and marketing company Cello Group lost 58% of its value in less than 5 months, and its revenue growth rate dropped from 27% to a negative 8%. So what does all this mean? Well, we have short memories. A market crisis can hurt. It doesn't matter what sector you're in or what business model you have. A global crisis can dramatically affect everything you're doing in your business, and with immediate effect. Another global crisis is building right now. 8 years of quantitative easing and central bank money printing has created a monster. In this time, it could be worse, deeper, and longer. The central banks and governments around the world just don't have as much ammunition to save the day as they did back in 2008 and 2009. Now, just as a brief disclaimer, the study is not intended for academic research or for nitpicking over small details. It's intended to give perspective about the risks in the financial markets that we face as company leaders and which we may not be so aware of. Looking at current market conditions now, the debt to GDP ratio has increased in all advanced economies since 2007, and some in a very dangerous way. Since 2008 in Europe, government debt to GDP has skyrocketed. A higher debt to GDP ratio is acceptable when an economy is rapidly growing, because its future earnings will be able to pay off the debt more quickly. But it's not acceptable in an economy that is not rapidly growing, and that unfortunately is the case in most of the world today. In Spain, debt to GDP is high and growing, and yet its GDP growth rate is low. Italy's debt to GDP is very high and growing, and its GDP growth rate is very low. Portugal's debt to GDP is very high and flat, and yet its GDP growth rate is very low. The UK's debt to GDP is high and growing, and its GDP growth rate is low. France's debt to GDP is high and growing, and its GDP growth rate is low. Belgium's debt to GDP is high and growing, and its GDP growth rate is low and flat. A bright spot, Germany's debt to GDP is medium and declining, and its GDP growth rate is medium. Switzerland is relatively unconcerned, as it has a low and stable debt to GDP ratio, but it has a low and declining GDP growth rate. What about China? China has a low but rapidly increasing debt to GDP ratio, and its GDP growth rate is high but declining. One concern about China is that it's in a real estate bubble, with residential prices up 80% in Shenzhen and 65% in Shanghai in Q1 of this year, and the yuan per square meter has doubled in the past year. What about the U.S.? In the U.S., debt to GDP is high and increasing. In the U.S., there is $19 trillion in government debt, or $162,000 per taxpayer. The U.S. GDP growth rate is low and flat. The U.S. economy is growing at a very slow pace. In fact, the 2.1% growth per year since 2009 makes the current economic recovery in the U.S. the slowest recovery since World War II. And the U.S. 10-year Treasury bond yield is at an all-time low. Elliot's Paul Singer says this bond bubble is the biggest bond bubble in world history. And perhaps the most concerning fact of all is that the U.S. is moving to the 0 point, i.e., the point at which a dollar of debt no longer produces any GDP. Every dollar of debt has produced less and less GDP since 1996. The more money that is printed, the less effect it has. What about Japan, which is the world's third largest economy? Debt to GDP is very high and growing. Its GDP growth rate is very low and declining, and Japanese investors are leaving Japan. So, high debt, low GDP growth rate, not good. What about unemployment levels? In Europe, unemployment levels are still high, too high, especially youth unemployment. So high debt, low GDP growth, and high unemployment mean negative interest rates. The poor economic conditions have caused several of Europe's central banks to cut interest rates below zero to encourage lending. Italy is issuing government notes at a negative yield. The average yield on the German 5-year note is now minus 0.5%. The average yield on the French 5-year note is now minus 0.4%. The yield on the Spanish 10-year bond has fallen below 1%. And in the UK the UK 10-year note is now only 0.6%, having declined significantly since the Brexit vote. There have been steep fund outflows from the UK since Brexit. The current account deficit in the UK is now more of a problem, since deficits are financed by foreign investors, and leaving the EU will make it more difficult for the UK to attract such investors. This means funding the deficit with a weaker pound or higher interest rates. A weaker pound is expected to drive up inflation rates, as well as inflate risky assets. For Q3 of this year, the UK is expected to be the only major economy in reverse. Yet, look to the Bank of England potentially cutting rates even further. Make no mistake, these very low and negative rates mean trouble ahead. Negative rates can cause commercial banks to want to pass on the cost to their customers. They can cut deeply into banks' profits and cause capital flight. So far, the negative interest rate policy has been ineffective in boosting bank lending. Demand for goods and services is not increasing. These pressures have persuaded former Fed Chief Alan Greenspan to believe the Eurozone is unlikely to survive in its current form. As he says, it is already showing signs of breaking down. The successful investment fund, Rothschild Investment Trust, is saying, "We are in uncharted waters, and it is impossible to predict the unintended consequences of the very low interest rates." In Germany, savers are now buying home safes to stash cash away. So, how much negative yielding debt is there now? $13 trillion, which means not only trouble, but big trouble. The value of negative yielding bonds has hit over $13 trillion, which compares with $11 trillion before the Brexit vote just a few months ago. Two-thirds of the world's sovereign supranationals and agency bonds are now at negative yields. Bill Gross of Janus Capital says global yields are at the lowest levels in 500 years of recorded history. $13 trillion of negative rate bonds. This is a supernova that will explode one day. The value of global debt trading at negative interest rates surged another $300 billion in just 1 week, ending the 13th of August. So how much does $300 billion equate to? Well, it equates to 29 aircraft carriers, or 200 identical replicas of the tallest building on Earth, or 50 hyperloops going from LA to San Francisco in 30 minutes. This is the amount of negative yielding debt created in just 1 week. The ECB's corporate bond buying program has stirred so much action in the credit markets that some banks and companies are even creating new debt, especially for the central bank to buy. And the European banks? They're close to a crisis. A healthy economy needs healthy banks, but the European Bank Index has plummeted over 40% over the past year. The longer negative rates stay in place, the more margin erosion there will be, and the more damage they will do to Europe's banking system. In just 2 days after the Brexit vote, major EU banks lost almost 25% of their value. Some banks, such as RBS, HSBC, and Bank of Ireland, said they will now charge business customers with large balances to hold their cash and impose negative rates on some major client margin accounts. Euro-based accounts will clearly be impacted. In terms of banks in trouble, is Deutsche Bank the next Lehman? Its shares are down over 60% from its 2015 high, and research firm ZEW estimates that Deutsche Bank's losses could outstrip its market cap. German banks, as well as Spanish, Italian, Greek, and French banks, still carry a lot of non-performing debt that acts like an anchor on the Eurozone economy. But while the banks are struggling, general stock markets are rising while earnings are falling. Corporate earnings in the U.S. have been falling since 2014. Normally, an earnings drought like this would cause the stocks to fall, but the S&P 500 has just hit a new all-time high. A rising stock market typically means more sales and more profits on the horizon. But do the current unstable political conditions, Brexit, Trump, Sanders, Corbyn, Le Pen, Podemos, Ciudadanos, Grillo, etc., and the current unstable economic conditions, negative interest rates, high debt to GDP ratios, low to negative GDP growth, high unemployment, today tell us that we should be expecting higher sales and profits? No, we shouldn't. HP is a case in point. Its revenue declined by 11% in the last quarter, but its share price has risen over 40% in the past 3 months. All U.S. stock markets are at record highs as investors go to extremes to find yield. As Robert Schiller says, people are most pessimistic about their own future, yet stock prices are at their highest. Over 70% of S&P 500 stocks have a dividend yield that now exceeds the 10-year Treasury yield. The dividend payout ratio is approaching the 2009 high. Is this going to hurt CapEx and to some extent U.S. productivity, which is crucial to resolving the high debt to GDP ratio and the low GDP growth problem? In fact, corporate profits, adjusted for inventory and capital consumption, have been in a downward spiral ever since growth peaked at more than 50% in 2010. Investor Jesse Felder says, over the past half century, we have never seen a decline in earnings of this magnitude without at least a 20% fall in stock prices. So, is there any good news? Yes, there are still 40% of U.S. workers left to capture via the internet. But, regardless of business opportunities that exist today, we don't know when the next crisis will hit, or what exactly will cause it. But what we do know is that a crisis is going to hit, and it might be soon. So any company that wants to be prepared, to be able to predict its performance, to be able to preserve its current performance and its business plan, needs to have a plan B right now. Otherwise, one day, maybe soon, we wake up to an ugly, bleak, and sad future, which didn't have to be. For more information and to get a copy of our full research report, as well as to register for our upcoming webinar, please contact us at contact@aquapartners.com.